Good morning, good afternoon, good evening. So, we're going to spend the next few minutes talking about what to anticipate and what do we expect leading into 2023. So, we've obviously seen a really rough 2022 for the entire market. We've obviously seen a major move down from the beginning of the year. SPY is down about 21%. The Qs are down more than that, about 34%. Dow Jones, you obviously can see, has outperformed, but is down about 10% at this point. And then IWM, also known as the Russell, is down about 28%. So all in all, most indices outside the Dow Jones are down 20% plus in 2022. Now, what's been the cause of this? Obviously, we've seen a rising interest rate environment. That's obviously called additional pressure. We also saw Russia issues. We have also seen the dollar strengthen significantly, and all of this is carrying into 2023. So, what do we expect? Are we going to see a move back to all-time highs? Are we going to see a move back to pre-COVID lows? What are we going to see in 2023? Well, we want to touch on that and kind of give you some things that I'm personally watching for. Once again, I have no idea where the market's going to go over the next 12 months, but based on probability and technical analysis, I can give you some indications on what we can expect. So, first and foremost, on the daily chart, we have just continued to be consolidating in this range, consistently forming lower lows and lower highs. So, at this current moment, we have broken down from our previous support right here, which every time we have broken a previous support, it has resulted in a move down to lower lows. Okay, so as you can see, all of these result in a move down to lower lows. So with this being the situation and us continuing to respect this trend line, these lower lows are around the 300 level. Okay, they're around the 300 level at the current moment. Now, as you know, as long as the date continues to expand out, this will continue getting lower and lower and lower and lower. Why? Because you're in a big consolidated broadening formation at this point. Okay, also known as a megaphone pattern. But you've continued to just chop all the way down here. All right. So on the daily chart leading into the new year, we are breaking down and we have the potential to revisit the 300 level. Okay. At the current moment, you do see that we are just consolidating in this box. Okay. We're just consolidating this box, obviously waiting for one direction or the other. If we move up, it is going to be very important that we continue to reject this trend line if this is going to play out. Okay. If at any point next year we break above this trend line, we have a gap to fill here, which is going to be very pivotal. Okay. Very, very pivotal. So if we do get a breakout, that's what I'll be looking for once again to form a new lower high to result in a bigger move down. But once again, if we break out, that could also confirm a breakout, just as we've seen for the recent strength of Dow Jones. Okay, so that's where we're at currently. Leading into next year, we could see a move down to around the 300 level if this pattern continues to hold. Okay, let's zoom out, look at where we're at on the current time frame, and then kind of look to see what's going on. So at the current moment on the monthly chart, we have continued to ride this. Sorry, let me move to the 6 month. It's a little bit easier for you. We have continued to see this type of just massive uptrend. Okay, I tweeted this out previously, but this is what we call a bearish engulfing on the 6 month. This is an evening star, and this is an evening star. All significant reversal patterns. Okay, this is the 6 month chart, so obviously we are going to flip into the 12 month chart to take a look at what happened this year. So as you can see, we gave back almost all the gains for 2021 off of this candle right here. Almost all the gains. But one thing you will notice, we did not engulf this candle. Okay, we did not engulf this candle, meaning a bearish engulfing is a reversal candle that normally results in a bigger move down. Okay, So on the 12 month, we have not confirmed that bearish engulfing. If we look at the Qs, we have. Okay, so you can see the Qs have fully put in a bearish engulfing right there. Okay, that's a reversal candle leading into this year. All right, so obviously you can see there's significant weakness in the Qs, just like we talked about at the beginning of the stream. So 12-month chart, it is okay. 6-month chart, not looking too great. Okay, this is not looking too great. It is going to be very important to see how Apple does this year. Apple is the biggest holding of the entire market, and it is going to be very, 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 very important to see how this does this year. Okay, if we are looking at the 12-month chart, you will see that Apple has put in a bearish engulfing candle, which is a trend reversal candle to the downside. Okay, now I've talked about Apple a good bit. If you've been a part of the streams, I've been comparing it a lot to Tesla and the breakdown that we're seeing on Apple right now. So this is going to be very pivotal for the entire market. We have a gap to fill down here at $95, which is 26% down for the biggest holding in the entire stock market. Okay, this is why it's hard for me to be very bullish going into 2023. I tweeted this out previously. I've talked about this a lot on stream as well, but we have started to change the trend, the direction of Apple. Okay, you can see we bounced off of the 200 SMA consistently. Here we obviously got through, and now we're starting to be walked down by the 200 SMA. All right, we have seen this happen a ton this year. All right, one of the best examples is Amazon. Right, you saw that it was just continuing to find support off of it, and then the moment it broke down, it started to reject. You have seen Amazon pull back a good bit of about 51%. Okay, so Tech General Amazon has fallen, Google has fallen as well, Microsoft has fallen as well, but you can see that Apple has not. Look at Microsoft, how well it has respected this 200 SMA to the downside. The moment it came back tested, it rejected, new lows, came back, rejected again, new lows. Okay, so we're seeing the same thing on Apple right now as well, as we are rejecting this 200 SMA. So it's going to be very important to see how Apple does leading into this new year, but right now it is not looking very promising to the upside. Okay, so if we do get a rally back to 200 SMA, once again, could provide a nice short entry as we target this gap fill of around $96. I am not bullish on Apple leading into this new year. Going back to SPY, the thing we've been talking about a lot, all right, is this 921 EMA crossover. I talked about this a good bit early throughout this year, and it's still holding true. So let me see on a line chart. Okay, this works just as well. You can see that we have crossed twice in history. You can see the 9 EMA, the blue line, has crossed the orange line twice in history. All right, and we are crossing again to the downside now. This, once again, does not give bullish indication of what we've seen on the charts. Okay, it does not give bullish indication of what we've seen on the charts. So it is something to keep an eye on throughout this next year. Okay, so I personally think that we are working our way down to 320 at minimum for the S&P 500 by year end. Okay, that's what I am looking at, and that comes based on the gap fills that are below. Okay, so we have 336 here, and the true support comes down to around this 320 level. You can see the prior high, prior low as well. We bounced around this zone, which sits around the 320 level. So this is my target zone for S&P this year, is 320. So I do think we could be in for another very rough year. Puts us down about 15% going into this next year. Okay, so We've obviously seen a significant outperformance for XLE. Okay, if we go just to the 12 month, we have seen a significant outperformance for XLE. Look at that. Look at that. From last year to this year, we just have a massive rip of a candle. Okay, XLE absolute dominant fashion this year. All right, XLI significant strength in comparison to the overall market. As you can see, if we look at the Qs, massive bearish engulfing. Okay, so this past year we've seen industrials lead, we've seen energy lead. If we look at XLF as well, you have seen this is what you call a bearish harami candle. You have seen them have an okay year as well. All right, so interesting year for sure. Divvies are crushing everything else, as you can see with Dow Jones. We look at the 12 month, it is significant outperformance. You can see that we have put in a hanging man candle, but we have not put in any sort of confirmation of a reversal. So very important to know that divvies have outperformed this year. Divvy stocks outperform in a higher interest rate environment. Fed Jay Powell has confirmed that they are going to continue in a high interest rate environment for all of 2023. That is why we've seen a pullback on the market over the past month. It's been pulling back given the fact that Jay Powell said we don't have any anticipation of slowing down these rate hikes, and that's what the market was projecting. So with that being said, Dow Jones has historically outperformed in higher interest rate environments, which means we still could see Dow Jones outperform leading into 2023. Now, at some point, if bear markets, there are stages of bear markets. Bear markets go through 3 normal stages. Okay, the first is unprofitable tech normally starts selling off significantly, which we have seen. Okay, Twilio getting absolutely destroyed, Shopify getting destroyed, UPST getting destroyed. I mean, we can go on and on and on, but you can see all of these unprofitable tech just getting absolutely destroyed this whole year. Okay, now the second phase of bear markets is the tech generals, Apple, Microsoft, Google, Amazon, start to fall. Okay, we've already touched on this a good bit already, but the last domino to fall is Apple. At this moment, everything else has fallen. Apple is significantly outperforming everything else. Okay, but you can see that we are starting to break down on the monthly chart right here. What we've been looking at is here. You're starting to see that breakdown. So that very well, from a monthly chart perspective, puts around $76 on the table for Apple. Once again, I'm still looking for 95 for the gap fill, but longer term, it does put 70, 75 on the table. So we could be in for a rough move on Apple. Okay, so that's phase 2 of bear markets. Phase 3 is everything else starts to decouple. We're talking financials, industrials, healthcare, consumer staples, consumer discretionary. All the other sectors that are significantly outperforming start to fall. So that is what I'm watching for in 2023. Do we start to see rotation of other sectors significantly underperform the market or not? Are we still going to be in a prolonged tech generals slide before we get there? So what I am looking for is I expect quarter 1, quarter 2 to still be the further continuation of some of the tech generals. Quarter 3, quarter 4, I expect the others to start to decouple. If we confirm that we go into a recession, okay, I know there's a lot of controversy there, but if we confirm we go into a recession, keep a close eye on XLI. I believe XLI will lead to the downside on the market if we go into a recession. As you know, I touch on this all the time. I look at gap fills as targets. Historically, industrials are late cycle movers. Okay, they're historically late cycle movers. Late cycles of bull markets, late cycles of bear markets. There is a massive gap to fill to the downside, about 35% down over the next year to 2 years if we go into a recession. Okay, so industrials are one of my top watches leading into 2023 for downside over the next 12 months. Okay, so I'm looking at names like Caterpillar, I'm looking at names like Deere, I'm looking at, you can feel free to look at all the industrial names, but I am looking at these to be a downside play leading into next year. What else am I looking for to lead to the downside? Two other sectors. XLF, I'm looking to lead to the downside. Okay. You can see that we are trying to push back up on XLF, but we still have that massive gap to fill to the downside. So there's still a lot of downside to be had on XLF here, about 26% down. And then I am also watching XLE. Okay, I'm also watching XLE here as well. Now, why XLE? Well, we have put in a double top here on XLE. We have not confirmed a breakdown at this point as we still are trending higher, but this will be very pivotal. If we come down to bounce off of 77, we could potentially move higher into 2024. Okay, we could. TA indicates that this is a bearish type of setup that leads to normally a test of the previous support, which would put it around 72. Now, with this uptrend line, there obviously that comes into play around 77, but we still have our gap to fill on the weekly around 73. So I am watching those as potential downside winners leading into 2023. Now, you're also not going to hear me talk a lot about upside winners. Why? Because the Fed has confirmed that they are not going to be lowering the interest rates and pivoting leading into 2023. I've touched on this chart a lot. We've touched on it a lot throughout stream as well. I'll leave it here so you can kind of see the full picture. But just as a reminder, dating back to 1973, as long as the Fed is still raising their interest rate, the market has historically not bottomed. And it has historically bottomed 1 to 2 years after the Fed starts lowering that rate. Fed J. Powell has confirmed they are moving higher on this rate through all of 2023. So the best case scenario we have is 2024 is where the bottom is in, 2025 starts our new bull run. That is the best case scenario that I see for the market, and hence why I am preparing for quarter 2, quarter 3, quarter 4 of 2024. This year still looking to play further downside. Now, with that being said, I do believe there will be another very, very volatile year with extreme rips to the upside. I would not be surprised to see a test back to the 420 level sometime this next year. It would not surprise me. Now, that would be very important to know how we react to this level here, okay? Because we still have a lot of previous demand turn to supply. So if we do get back up here 426, this could allow for a very, very interesting short position if we reject off of there. Okay. Now, once again, that would confirm that this breakout happens, right? That would confirm the breakout happens, and that could lead to a very interesting 2024 if we do break out. But at this current moment, I would not be surprised to see us continue to move down to 330s, okay, 335, 330s here, and then potentially look to get a bigger move up here. What could be the catalyst for that move? Well, if Jay Powell has to pivot early than what they expect, we could see the market rip, okay? We could see the market rip. And just like I talk about playing gap fills to the downside, there's also a gap to fill to the upside at 420 here. Okay, so that would not surprise me if we fill this gap. Now, once again, we don't have to fill the gap within 12 months, 24 months. We will fill the gap over time. We just don't know how quickly. Okay, so at some point we'll go back to fill that. So my plan leading into 2023 is short every single rally as long as the Fed is not changing course. Okay, That is my course of action. Short every single major rally, knowing the fact that the market has historically never bottomed as we lead into a higher interest rate environment. Now, a lot of people are expecting that we just raise interest rates super high because this is the fastest interest rate climb we've ever seen in history, and then we just start dropping them super fast as well. I don't believe that. Personally, I believe we see higher for longer. That is personally what I believe we see, which could lead to some outperformance of Dow Jones over the next 4, 5, 6 years. A lot of people are not fans of Dow Jones stocks. Why? Because they've underperformed for the past decade. They've been riding higher by tech, and so they're very allocated to tech. Sure, that's worked for the last decade, but what's going to work over the next decade? And we could see some outperformance for the Dow Jones, old boomer stocks, as some people like to call them. So keep an eye on those. Okay, keep an eye on those. But like I said, my plan is the market revisits the 320 level, right around this level. So what I'm looking for on the market. Okay, it revisits right around this level, and anything that moves up that stays under this level here, 430, provides new short entries for a move back down. Okay. Everyone is talking about the earnings recession that's coming. It's going to be very important to see, does that hit us in quarter one or quarter two? A lot of people, including me, were expecting it to hit last quarter, but we saw a nice move up in earnings. A lot of stocks outperformed, beat earnings, and even kept their guidance the same or raised guidance. An earnings recession will come. It happens in bear markets. Okay, the consumer's still technically strong. We've seen it for retail sales. We've continued to see it for Black Friday. We have seen that the consumer remains strong. And that's held us up for a little bit. But at some point, we're going to see an earnings slide. The question is quarter one or quarter two. If it is quarter one, once again, we are targeting 330 as the revisited level, given the trend line from previous. Okay, you're looking at around the 330 level on that. If it does become quarter two, quarter three, then obviously we could see a move back into this gap here, 420, and then further continuation down. So, do we see 400 again? I would not be surprised. My personal plan leading into next year is look for short entries around this 396, 397 level until this pattern breaks. Okay, till that pattern breaks. If this pattern breaks, well then obviously we cap the potential of a trend change, and that could change things from there. But this would provide a potential nice short entry to lead to new lows in the future. Okay, all right. That is what I am looking at within a lot of the market. Here's a tweet about what my projections are leading into 2023. Please understand that these are based on current chart patterns and my macro knowledge. There is absolutely no guarantee that all of these will hit or any of these will hit. So there is full disclosure there. But this is what I'm expecting leading through 2023. These are not year-end targets. These are at some point within 2023. These levels trigger. Okay, so that I do believe everything on this list has further downside ahead of it. Okay, everything. So here's just a few things for you to look at. I know last year I did like 10 stocks to watch and things like that. I'll do that again this year. But I wanted to get this out there for you to have a bunch of names to just look at yourselves and kind of figure out, how did I come up with my projections? How did these targets come into play? You know, like, I want you to learn the TA side of things to educate yourself enough to figure out where this came from. All right. But here's just a bunch of stocks to consider and things to consider leading into the new year. So you can see Apple, I'm targeting $96. That's that gap fill. Okay, it's about 20% down. That's going to hurt the market. Okay, it's going to hurt Qs. So here's just a few stocks for you to consider looking at leading into 2023. Okay, a few of the things for us to think about. Dixie. Okay, Dixie is going to be very, very important this year. Very, very important. If Dixie remains strong, okay, if Dixie remains strong, bounces off our trend line, our target, it is almost to our target now. It is entering that at the current moment. But if this bounces, we are going to be under a lot of pressure with the market. Okay, there's going to be a lot of pressure under the market. If we can start to break this trend line, there is the potential of that relief rally. Okay, that relief rally back to 420. But more important than Dixie is the VIX. Okay, throughout all of last year, every time the market has clipped 20, it has significantly told us to short everything. Okay, it's told us to short everything. Every time it has clipped 20, it says short everything. And every time it has come up and clipped the 33 level, it has told us to consider getting long or selling out of short positions. Okay, so this pattern has worked very well throughout 2022, and I am watching for it to continue to work out through 2023. Okay, this is what capitulation looks like. Okay, this is what capitulation looks like. This is what you're looking for to significantly say, all right, the bottom could be in, the low could be in, because VIX is through the roof. Okay, you can see the line in the sands around 45. All right, a move above 45 has significantly marked some of the lows on the market. So I'm going to be keeping an eye on VIX throughout this whole entire year to see, do we get that 45 mark or higher this year? Personally, I don't think so. I think we get this next year into 2024, but I will be watching it from here. So here's just a few things to keep an eye on and what's worked all of 2022. Under 20, it says short everything. Above 33, it says decrease your short exposure, look to get long. And it has worked tremendously throughout all of last year. Okay, so just a few things to take away leading into the new year. First and foremost, I do expect another rougher year for the market. Okay, my target is 320 on the market. I expect another rougher year for the market. I also expect that crypto continues to target our 10K range. Okay, we continue to target our 10 to 12K range. That is still what I expect, and I do think that crypto hits this within 2023. I think we see that range. Okay, Ethereum, if we get the range on Bitcoin, this should see under $500. Okay, Ethereum should see under $500 leading in through 2023. Okay, XLI and XLF are my two sectors that I'm watching for the most downside throughout 2023, and I am also looking for a lot of unprofitable tech companies to either go bankrupt or get bought out by bigger companies. Okay, those are some of the high level things that I'm watching leading into this next year. So the Fed is still forming exit liquidity. Okay, it is very dangerous to long markets when the Fed is against you. It is one of the primary rules of technical analysis. Do not fight the Fed. Okay, so until the Fed changes course, I will personally only be looking to play the downside of the market. If we get another rally, I will look to sell cash secured puts, as I've done. But I will be looking only to play the downside of the market until the Fed has stated, hey, we are pivoting, we are moving towards an easing cycle again, and now's the time that we start to look to get long and play the upside again. Okay. One other sector that I want to throw out there, uranium. Okay, we've talked about this a lot, but uranium. Uranium is completing a 6-year long accumulation pattern. Okay, 6-year long accumulation pattern. And it's working on a bull flag. It's working on a bull flag. Technical TA says this revisits $16 and then breaks out, it absolutely has a crazy 2023 with a target of 42, longer term target of potentially 65. Okay. This does not mean that it has to come to 16. This is just the traditional TA and what's happened. Okay. But this isn't a bull flag with the potential for a massive, massive move up. So if there's anything that I'm looking to get long, it is uranium leading into this next year. If uranium has a massive year, it could be led by an energy crisis within Europe. If that's the case, XLE could break out above its double top and continue to rally throughout 2023. Okay, so I'm watching an energy crisis in Europe to play out. It would help uranium. I'll look to get long here, but everything else I'm looking to get short. Okay, so that's my playbook leading into 2023. I hope you get some value out of this. Remember to be defensive because we're still in a tightened cycle right now. Long-term projections, I'm still thinking we do run the lows of COVID. Okay, still think we run the lows of COVID longer term into 2024 things. So I'm still looking to play downside only at this current moment, and that's my playbook leading into 2023. So if you appreciate this video, got value from it, be sure you like, subscribe to the channel. I'll be trying to get more YouTube content out throughout 2023. So thank you so much for watching this video, and I'll see you very, very soon.